Today, we're diving into something pretty specific but really interesting in finance and AI.
Yeah, it's about whether these, huge AI models like GPT-4 are always the best tool for the job.
Exactly. Can smaller, maybe more focused AI models actually, outperform the big guys for certain tasks? We're looking at financial news sentiment here.
Mm-hmm.
The source is a research paper called Fine-Tuning is All You Need. Compact models can outperform GPT's classification abilities.
Catchy title.
It is. So our mission for you, the listener, is to get a handle on whether bigger really is better in AI, especially for something as tricky as finance. And, what strategies make these different models tick.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
And finance sentiment is definitely tricky. It's a real challenge.
Why is it so hard?
Well, think about it. You've got super short bits of text headlines, tweets sometimes, very little context. Plus, you have numbers mixed in with the words and the news. It gets old, instantly. Its relevance just evaporates.
Okay. And how did people traditionally try to teach AI about this?
Usually, it involved people, humans, reading and labeling tons of news snippets. Positive, negative, neutral.
But that sounds subjective.
Exactly. That's the problem. Human labels can have biases, right? What one analyst thinks is positive, another might just see as, neutral information. It doesn't always line up with how the market actually reacts.
Okay, so human labels aren't the perfect ground truth for market sentiment. What did this research do differently then?
This is where it gets clever. They created a whole new data set, but based it on objective market events. Not human opinion.
Market events. Okay, how?
They took Bloomberg Market Wraps, these daily summaries of financial news going back quite a way, 2010 to 2024.
Wow, that's a lot of data.
Yeah, and they used GPT-4 actually in a sort of two-step process. First, to pull out the most important headlines from these daily wraps, and second, to automatically figure out which companies' stock tickers were mentioned in those headlines.
Got it. So step 1, find the news. Step 2, find the companies. What's step 3? Labeling the sentiment.
Precisely. But instead of asking a person, they looked at the stock market reaction for those identified tickers.
So they looked at what the stock price did the next day.
Exactly. They compared the next day's price change to how that stock usually behaved over the last 5 years. They used this quantile method.
Quantile, like percentiles.
Sort of. Imagine ranking all the daily price changes for a stock over 5 years. If the price changed the day after the news fell below the bottom 30% mark of its usual changes, they labeled the news sentiment as negative.
Okay, that makes sense. Below average drop.
Right. And if it jumped above the 60% mark, so a bigger than usual jump, they called it positive.
And in between.
Neutral. The idea was to capture the sort of overall market reaction across multiple companies tied to that one headline, not just one person's guess.
So they calculated the median sentiment across all the stocks linked to a headline to get a broader picture.
That's it. They wanted the macro effect. And crucially, they checked if this data set actually made sense. They built a really simple trading strategy using these labels. Buy on positive, maybe sell on negative. And guess what?
It worked better than random.
It did. It outperformed a random benchmark. Now, there's a bit of look-ahead bias acknowledged there, but it strongly suggests the labels captured something real about market tendencies.
Okay, that validation is important. So they have this objective market-based training data. Now, the main event, comparing the models. Who are the players?
Right, so they pitted GPT-4 against two smaller contenders, FinBERT and DistilRoBERTa.
FinBERT sounds familiar, isn't that one specifically trained on financial text?
It is, and DistilRoBERTa is basically a leaner, faster version of a well-known model called Roberta. Both are much, much smaller than GPT-4 in terms of parameters. Think of parameters as like the knobs the AI can tune while learning. Fewer knobs means potentially faster training, less resource intensive.
Okay, smaller, more specialized versus the giant generalist. What happened before they used the new data set, just testing them out of the box on financial news?
Well, this was interesting. GPT-4 was only slightly better. Marginally.
Really? Even with all its size?
Yeah. All the models actually struggled a bit, especially with identifying neutral news. It shows that, financial language is just inherently tricky, even for these sophisticated AIs initially.
So size wasn't an automatic win. What happened after fine-tuning? When they trained them all on this new market-based data set?
This is the core result, really. After fine-tuning on about 70% of that new data, their performance became, well, very similar.
So FinBERT and DistilRoBERTa caught up to GPT-4?
Pretty much, yeah. They achieved comparable accuracy in classifying the sentiment. The huge size difference didn't translate into a performance difference for this specific task after targeted training.
That's significant. What about training time?
GPT-4 took way longer to fine-tune on the same data, much less efficient.
So similar results, but the smaller models were faster and cheaper to train. Did the fine-tuning help with any specific type of sentiment, like positive or negative?
Yes, actually. All models got better at spotting positive events after fine-tuning. The researchers thought maybe the model's original pre-training data had a bit of a negative slant towards finance news, and this market data helped balance that out.
Fascinating. It really underscores how important the right training data is, not just the model architecture. Now, they also looked into something called Condorcet's jury theorem. What's that about?
Yeah, it's a neat idea from political science, actually. The basic theory is if you have a group of independent voters and each one is more likely to be right than wrong, then the majority vote of the group will be even more likely to be right.
Okay, like the wisdom of the crowd, but for AI.
Kind of. They applied it using a technique called bagging. Basically, they took the predictions from the fine-tuned GPT-4, FinBERT and DistilRoBERTa and used a majority vote to make the final classification. The hope was combining them would be better than any single one.
And did it work? Did the AI committee outperform the individuals?
Surprisingly, no. The bagging method didn't really give a significant performance boost.
Huh. Why not? What does that imply?
Well, the theorem relies on the voters, or in this case the models, being independent in their errors. The fact that combining them didn't help much suggests that, despite their different sizes and architectures, these models weren't making independent mistakes after being fine-tuned on the same data.
So they were kind of thinking alike, or at least making similar errors on this financial task.
That seems to be the implication. They showed behavioral similarities, converging on similar ways to classify this specific type of text once trained on that market data.
What's the potential downside of that? If all these models, big and small, end up agreeing after training?
It points towards potential redundancy, right? If you're using multiple massive models hoping for diverse insights on this kind of task, but they end up behaving similarly after specific fine-tuning, maybe you're not getting the benefit you think you are.
You might just need one well-trained, efficient model instead of a whole committee of similar thinkers.
Exactly. It suggests there might be diminishing returns to just scaling up model size for certain specialized classification problems, especially if the fine-tuning process aligns their behavior. Efficiency could be key.
Okay, let's wrap this up. What's the main takeaway you want listeners to remember from this deep dive?
I think the big one is that fine-tuning really is powerful. Smaller, compact models, when trained well on relevant, objective data, can absolutely hold their own and even be more efficient than giant models like GPTs for specific tasks like financial sentiment analysis.
So bigger isn't automatically better. Context and data matter hugely.
Absolutely. And that market-based data set they created, that's a really valuable contribution in itself, a way to benchmark models against actual market reality, not just subjective human label.
Right, moving beyond opinion to outcome. It definitely leaves you wondering, though, if different AI models, even with different structures, tend to converge on similar answers after targeted training, where does the real edge in analysis come from? Is it just finding better data? Or are there other factors entirely we haven't even touched on?
That's the provocative question, isn't it? What does this mean for developing AI in specialized fields going forward? Maybe it's less about brute force size and more about clever data and fine-tuning strategies.
Definitely something to chew on. Thanks for breaking all this down today.
My pleasure. Good stuff to think about.